All right, this is it. After months of basically flying blind, the new inflation report has finally landed. And let me tell you, these numbers could signal a huge shift for the economy and, more importantly, for your wallet.
It really all boils down to this one question, right? Will your borrowing costs finally go down this spring? I mean, everything from mortgages to car loans is tied to the economic data we're about to dive into. So, are you going to get some relief? Let's find out.
Okay, first up, let's break down this long-awaited report card for the economy. Now, this isn't just any data release. This is the first real hard look we've gotten at inflation in months, and the timing is absolutely critical.
To really get what's going on, you have to understand the backstory here. We haven't seen this data since way back in September. Why? Because the government shutdown put everything on pause. That created this data blackout, a ton of uncertainty. And that's exactly why everyone, economists, the Federal Reserve, you, me, has been on the edge of their seats waiting for these December numbers.
And here it is, the big number. In December, inflation came in at an annual rate of 2.7%. So, what does that mean? Well, it's not a huge jump, but here's the key. It's not a drop either.
And that idea that inflation isn't really going down, but it's not speeding up either, is the main story here: stability. If you look at it month over month, prices ticked up just 0.3%, which is exactly what happened in the last report. It's like the economy is just holding its breath. For the Federal Reserve, this is a huge piece of the puzzle. It tells them inflation isn't defeated, but it's not running wild either.
Now, before we go any deeper, let's do a quick sidebar on a term you hear all the time: core inflation. So what is it? Basically, economists take the main inflation number and pull out the prices for food and energy because, they can be super jumpy. What's left gives them a much smoother, clearer picture of the underlying trend.
And this chart, wow, it shows you exactly why that matters. Look here, core inflation is sitting at 2.6%, but the things we all have to buy every single day, a roof over our head, food for the table, those are actually rising even faster. We're talking 3.2% for shelter and 3.1% for food. This shows you that the pinch on our household budgets is still very, very real.
So how does this all factor into the Federal Reserve's next big decision? Well, with this new data, it's pretty clear they're in the middle of a very delicate balancing act, and it looks like they're just going to hold steady at their next meeting.
You see, the Fed is basically walking a tightrope. On one side, they've got their main mission, to get inflation back down to their 2% target. And it's been stubbornly high for 55 months in a row. But on the other side, they have to support the economy. Remember, they already cut rates 3 times late last year because the job market was starting to look a little shaky. They can't risk slamming the brakes so hard that they stall out the whole economy.
And this is exactly why experts, like Sam Williamson over at First American, are pretty much all on the same page. This 2.7% number, it's not dramatic enough to force the Fed to do anything. It doesn't scream cut rates now, but it also doesn't suggest they need to hike them. So for January, the expectation is simple. They're going to wait, and they're going to watch.
So if January is off the table, where does that leave us? Well, all eyes are now shifting to the future. And that brings us to the million-dollar question that could really define the whole spring season. Could the Fed actually cut rates in March?
And the answer is, yeah, it's possible. According to that same expert analysis, while this report didn't guarantee a rate cut, it did just enough to keep the hope alive. You could say the door for a March rate cut is now officially open.
So what needs to happen for them to actually walk through that door? It really boils down to 2 key things. First, the Fed needs more than just one report that's kind of stable. They're going to want to see a clear, confirmed downward trend over the next couple of months. And second, if the job market keeps getting a little weaker, well, that would put a lot of pressure on them to cut rates and give the economy a little boost.
Okay, let's bring all this home. We've talked percentages, we've talked policy, but what does this actually mean for your bank account, especially if you're thinking about buying a house or a car this year?
The big deal here is the timing. A potential rate cut in March lines up perfectly with the start of the busy spring home buying season. And if the Fed acts, we could finally see mortgage rates start to drift down. It might not be some massive drop, but it could provide some much-needed relief on the affordability front. So for anyone even thinking about buying a home this year, the next few economic reports are absolute must-watch events.
I want you to focus on that phrase, incremental affordability relief. That's key. We're not talking about a life-changing drop in rates overnight, but that modest little dip could be just enough to bring people who've been sitting on the sidelines back into the market, which could really heat up demand just as spring kicks off.
And so we end right where we began, on a knife's edge. This latest data has kept the hope for lower borrowing costs alive, but it is far from a sure thing.
The next report is just a few weeks away, and it could be the one that finally tips the scale one way or the other. We'll definitely be watching to see which way it goes.